It's a huge misconception right now, especially with rates the way they have been the past couple of years. Everyone wants to save as much as they can money going into the purchase to then put it down in the house. But then when we actually go into the numbers with them on how, if they put less money down, how little that actually affects the monthly payment, clients are shocked 90% of the time.
Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Brock Lassick, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth. Ready? Let's do it.
All right, welcome back. Today we're talking about one of our core pillars in the way that we guide our clients. Our holistic mortgage planning model is based around three major pillars, which is optimizing leverage, mitigating risk, and ultimately maximizing wealth. And today we're going to do a little bit of a deep dive on optimizing leverage, what that means, and why it's so important. And I like to say it's the cornerstone of basically everything we do, because it's like it challenges the common thought processes that people have, like putting more money down for avoiding mortgage insurance, putting more money down to get a cheaper monthly payment, putting more money down because they want their house paid off, constantly people think that, when in reality rarely do I ever see that's a beneficial plan, except for maybe people that are retired on a fixed income, have a ton of cash that they need invested somewhere that's going to create a simple passive return. That's the one exception, which is very rare, because most of those people just own their houses.
Yeah.
So,
I think the most powerful thing with optimizing leverage is just staying liquid. Cash is king. If you can have that cash on the sidelines, the opportunities are endless. Whether it's, subsidizing your mortgage payment or investing in other areas that's going to get you a greater return on investment. Or if there's
that's what's so counterintuitive is people think that it's the secure thing to do is have more equity in your house, invest more so your payment's lower so that you can afford it better in case of an emergency. And the reality is, like, $100,000 down saves you $650 a month. Well, if you had $100,000 in cash in a real emergency, a real financial emergency hit, well, here, let me back up. If you can't afford that $650 per month delta, you're probably spending too much on the house that you're looking to buy. If you're tapping it out too much.
It's true.
So if you really have to save that much money, you might want to reconsider how much you're spending on the house. Yeah. So in reality, people can afford that $650, and if you had $100,000 on the sidelines, assuming no other variables, you could subsidize that $650 a month for. So in other words, you could make out of that $100,000 that you would have put down on the house, you could subsidize that payment for 15 years, almost 12 and a half years with no return on investment. Right now you throw that money in a money market, it's going to make 4% or something like that. You could theoretically subsidize that $650 a month for 15 straight years. So it's not like there's more risk.
Typically when I see people are in dire situations, the $650 doesn't matter because they can't even make the mortgage payment anyways.
Yeah, exactly. It's like the $3,500 mortgage payment that still remains after saving the $650.
Yeah, it's still there.
It's still not good. So you bring up the best point, which is if and when you actually need to save the money, $650 is not going to be enough, or whatever amount. The extra amount you put down is not going to be enough to really solve the situation, because it's probably something significant, a sickness, a job loss, something crazy.
Yeah. I think that it's a huge misconception right now, especially with rates the way they have been the past couple of years. Everyone wants to save as much as they can money going into the purchase to then put it down in the house. But then when we actually go into the numbers with them on how, if they put less money down, how little that actually affects the monthly payment, clients are shocked 90% of the time. It's a no-brainer. Let's just put less money down.
Well, and people get so freaked out about, there's no way I'm paying PMI or mortgage insurance. Like, just not going to happen. I've got to do the 20% down. Number one, We have programs that you only need 15% down to avoid mortgage insurance with no impact to the mortgage rates at all. You get the same rates as if you did 20% down, but you only do 15 and there's still no mortgage insurance. So there are solutions around it. But let's just say you even only do 5% down. For well-qualified buyers, even people with lower credit scores, with only 5% down, your PMI cost is honestly only like a couple $100 a month, maybe.
Oh, yeah.
Or less.
If that. Yeah, it depends on how well qualified they are. But
right.
Yeah, I would say it's anywhere between $180 to $250 a month.
Yeah. So it's like not that big of a deal.
No.
And so optimizing leverage, I wrote down a few things before this, and that's kind of the crux of it, what we talked about now. But basically, there are some major benefits to doing this. One is preserving liquidity for a variety of reasons. We just talked about some of them. Number two is strategic debt management. And this is where a lot of people miss the boat and get confused or get tunnel vision on one specific detail. And then number three is investment opportunities, which TJ touched on. And number four is professional leverage, which kind of gets us out of the scope of the leverage on the mortgage, the financial leverage, into some other details. So like strategic debt management is another thing. We talked about payment subsidy. But a lot of people are like, well, I'm going to put this money down, but they have student loans or credit cards or RV loans or auto loans or whatever. And they're like, well, no, I don't want my mortgage payment to be higher. And they're not even considering the idea that, well, wait a minute, what if I dump that extra $100,000 or extra whatever thousand? It could be only 5,000. We're just pulling numbers out of thin air here, but let's say it's $100,000. Well, if you went and paid off $50,000 or $60,000 in debt, you're probably going to save $1,500 a month.
Yeah, it's going to do more bang for your buck because the amortization schedule on that is shorter than what it is on the mortgage.
And who cares if the rate is lower on that or what? Like that's where people get freaked out and stuck in.
But most of the time, it's not going to be lower.
Right now, it's not going to be lower. But even if it is, there's a couple things that I talk to clients. One, the mortgage interest is tax deductible, so borrow more on a mortgage. And if you let's just say you pay 30% in income taxes, well, the extra interest you pay on that mortgage by sweeping out all the other debt and deferring that into mortgage interest becomes tax deductible at a 30% discount, essentially, because you're going to save on income taxes. So, and of course, you got to talk to an accountant. Not everybody qualifies. We're not giving tax advice here, but conceptually and theoretically, let's just say the rate is at 6.5%, 30% discount on that means that after your tax benefits, your effective interest that you're paying on that debt is like 4.5%, a little over 4.5%. Almost certainly that debt's not cheaper than that, but also to your point, the monthly costs are so much greater because it's a shorter amortization. So then if you say, well, that's already baked into my budget, I put more money down or less money down on the mortgage, pay off these other debts. Sure, my mortgage payment goes up $600 a month, but I free up $1,500 per month. So I'm net positive $900 per month. Yep. Well, now if you throw that $900 per month back on the mortgage, you actually become 100% debt-free faster than if you did it the other way around.
Yeah. And you're accelerating your payoff too.
That's what I mean. Yeah, that's what I mean. 100% debt-free, like paying the house off and the debts and everything.
Yeah.
And you have tax benefits. And a lot of other things.
You can actually change your withholdings, again, talk to a tax professional, but you can actually change your withholdings so that way you're actually netting more on your pay stub every single time.
Yeah, that's true. So that's taking advantage of the tax benefits on mortgage interest immediately. So you can just reverse engineer these numbers with an accountant and say, okay, well, because we're buying this house, because we're financing this amount at this interest rate, we're going to have this much in interest paid. And you take the standard deduction, and we could walk through this with you, an accountant certainly could. You take the subtraction of the standard deduction and just annualize that into a monthly figure and go fix your withholdings. So on your paycheck, literally every month you could be netting the extra money. Or at the end of the year, you could just get a bigger tax refund.
Which is kind of how I do it.
Yeah, for sure.
I prefer that.
Same.
Yeah.
That way you're not paying unexpectedly. But on this strategic debt management, the other thing that I think about is, and we're some of the lines blur here, and so we want to be careful. But optimizing leverage creates this liquidity that is so much more powerful than it being locked up. Because remember, cash in a house is not liquid. You can't, unless you go get a HELOC or unless you get a cash out refinance or something.
Well, virtually means nothing.
It means nothing. It's just paper. And, those new loans are probably going to cost you money in fees. So why do that when you can avoid it? Keep the cash liquid. You could pay off other debts with it. You could subsidize payments with it. You could do both with it. Or you could reinvest the capital into other opportunities. So let's just say you the same thing. You pay off these consumer debts. Your payment on the mortgage goes up $600. These consumer debts go eliminated $1,500. So you save $900 per month. I wouldn't actually prepay the mortgage. You and I don't do that, but we do all this other stuff. Instead, we take that $900 per month savings and we throw that money right into the stock market or into another type of investment, maybe a real estate, in a rental or something. And we just invest that money there. Now we're compounding our returns with the same money, and our cash flow is better.
Yeah, but the money's working for us.
It's crazy.
Yeah, I mean, whether you own 5% of the house, 50% of the house, you still get the same returns. Might as well have your money working for you.
100%. Yeah. And the tax deductions are better if you have the leverage, which is nuts.
Yeah.
And it's like people get blinders on, like, I can only see a rate, I can only see a payment only on this mortgage. That's it. Nothing else matters. And you got to take those blinders off in a big way. So investment opportunities is the next.
Oh, yeah. Dive into that. I was confused with the professional investment opportunities you were talking about.
Oh, no. So investment opportunities is the third piece of the financial part.
Oh,
and I already just touched on it, but it's like throwing that $900 a month in savings. But there's some people that maybe the numbers aren't the same. Maybe they're debt free and they're like, well, I'm debt free. I've got a bunch of cash in the bank. I would just rather put the money down on my house because I just want a lower house payment. And it's like, if you look at the numbers, like, let's just say you're buying $600,000 house or $700,000 house. And you're like, man, I've got 200 grand or 250 grand that I want to put down. I've got all this saved. I'm debt free. I've got good income. I just want it simple. I want to buy a house and have a cheap monthly payment. That might make sense, but we would say, let's do maybe 10% down, 70,000 down,
10 or 15,
maybe 15.
If it's 15 to avoid that mortgage insurance.
PMI?
Yeah, sure.
So maybe you do 105,000 down, but you've got an extra 145,000 remaining. These investment opportunities are ridiculous because, yes, granted, your mortgage payment's going to be what? It's going to be 145 times, it's going to be about $950 more per month. But you can afford it because you're in this position where you're debt-free and you got a bunch of cash. So obviously you can afford the $950 a month. And if you just retool your thinking here, in that $950 per month is not an expense, that's an investment, because now what you get to do is you get to invest that $145,000 into the stock market or something else. But let's just say the stock market, for simplicity, say it turns a profit of 10% per year on average, and you invest that money for the next 30 years, which is the term of the mortgage. That $145,000, while it costed you $950 per month in the mortgage, costed you, and I say you invested $950 extra per month, put that money in the stock market, it turns into like almost $2.9 million in 3 years or in 30 years. Like, that's insane. And people miss that long-term view for instantaneous satisfaction that is like hollow satisfaction, because you don't need the, if you've had the ability to get debt-free and save $250,000 or any amount really for that matter. The numbers are always different and relative to people's earnings, but if you've had that ability, you don't need to save the $950 a month. You don't need to.
Well, if they didn't do that, what happens? Now they save $950 a month, spend it who knows where, and then the house 30 years later is worth what it is regardless.
Yeah, the house is worth the same. Yeah, exactly. That's a great point. Like, the house, you don't make more money on the investment of the house by putting more money down. You literally make less.
Exactly.
It's crazy.
ROI is negative at that point.
Yeah. So any other thoughts on just the financial optimizing leverage?
No, I think that was good. I think it's a good leeway for our episode next week, talking about either maximization would probably be the best.
Yeah. We're going to do, the next couple episodes are going to be mitigating risk and maximizing wealth. Those are our next two core principles with holistic mortgage planning. But the third thing, or the fourth thing I should say, is professional leverage. And this is something that, especially with the news recently, with all of the changes in realtors and commissions and those types of things, people oftentimes get mixed up in this idea that you should go at it alone. And there's some significant benefit to doing this whole process by yourself. I could just do my mortgage online. I could just not hire a realtor and just use ChatGPT to help me write the contract. You can do this stuff.
Yeah,
you
and
can.
These are legit things we've heard before.
And you can do it.
Mm-hmm.
I'm not saying you can't do it. But what I am saying is you've got to broaden your perspective and realize that professionals are in it. And now you got to find a legitimate professional, because we are in a low barrier to entry industry just at large. Whether it's a lender, a realtor, a title rep, whoever, it's not difficult to become licensed in our profession, unfortunately. That frustrates me a little bit. I wish it was more challenging. But you can identify legitimate professionals. Just go look at somebody's online reviews. If they don't have a bunch of online reviews that are really good, they're probably not a true pro. So find somebody like that. We're one of those people, I would say, in the mortgage space. There's lots of realtors that are that way. We could refer you to some. But leveraging professionals as opposed to getting stuck. Again, don't get stuck on payment on the mortgage. I got to put more money down because I want to lower payment. We're saying that on the finance side, but also on the professional side. Don't get stuck in this idea of, I can save this much in commission, or I can save this, or I can save that, and think about the one thing you can save. Because what you're missing, if you aren't objective with this consideration, is what can you lose without the wisdom and expertise and experience of somebody who does this hundreds or thousands of times every year. That's the reality. We do this thousands of times a year, analyzing transactions and qualifications and structuring deals. Most people, even avid real estate investors, do this maybe 20 times in their life. We do it hundreds of times a quarter. We do this all day, every day. We will have strategies, ideas, concepts, whatever. We're going to have advice.
Nothing phases us at this point either. We've seen it all.
100%. And we've heard it all. And we've heard the strategies from clients, from professionals, from competitors. We understand the programs and the changes and the nuances at such a deep level that a person that's not in our industry or as a realtor or whatever could never understand it the same way, regardless of having access to ChatGPT or whatever. So my point here is leverage professionals. Negotiate for your benefit, because you should. You can negotiate, you can shop, you can get the best possible deal, but find a true professional that's going to give you the proper advice.
We're back. He had a coughing attack.
So find a true professional that's going to give you the advice that, sure, could you do your mortgage and save $1,500 in costs one time? You could. But if you did that, you're not going to get the advice that we just gave you, which is restructure the deal this way, get a loan with no PMI with 15% down, reinvest, blah, 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 and ultimately still be debt-free, still have an affordable situation, and turn into a multimillionaire with the same money that you would have used that would have done nothing for you. So do you want, at the expense of $1,500 more, for somebody who's a legitimate professional and somebody you can trust, who's local, can really help you and advise you? Is that worth millions of dollars down the road? It's not. And the same thing applies to realtors. A realtor, I'll give you an example, and you might have one too. I had a client, bought a house without a realtor. He bought a house in a nice area. It was in Utah County, really nice area, but it was an interesting house. And he bought it without a realtor, and he also bought it without a home inspector. Why? Because he's a contractor. He understands how to, he understands this stuff. So he didn't need that support. Well, he didn't leverage the professionals like I'm telling you. He did leverage us as the financiers, which was awesome, but he didn't leverage the other professionals. He chose to go at it alone that way. Well, 3 years later, he starts having issues with his house, starts tearing it apart, finds out there's literally no foundation. The house was built on dirt.
Oh my gosh.
And now he's in a position where he can't qualify, because rates have come up. He can't qualify to remodel the house. The house is partly torn apart. He's trying to figure it out. And had he just gone down the path of trusting professionals, spending a few $100 or even a few thousand, he literally could be hundreds of thousands of dollars ahead right now. Hundreds of thousands of dollars ahead. And you can't foresee that stuff without somebody, without a realtor who's gone through and seen hundreds of houses. They've probably seen that house. They may have sold that house before if it's a legit realtor, So or a home inspector, if you've got a good one, which realtors have the best ones, right? Because they do it. you're going to avoid these costly mistakes. And so don't have short-sighted penny pinching, like you're literally tripping over pennies or tripping over dollars to pick up pennies in these scenarios. So,
well, that's just one thing. I mean, the market evolves so quick. The market can turn on its head where now we're seeing appraisal issues pop up more often than not. If you don't have someone in your corner that knows how to read an appraisal report, you can be SOL.
For sure.
And there's steps like that throughout the whole process. That if you don't have someone that you can leverage, you could be upside down pretty quick.
Yeah. And it takes intimate human experience and wisdom and knowledge and dynamic behavior to figure these things out. You need a true pro. Another example of this is property managers. So many people try to go at the process alone, renting out their house. Well, what you don't realize is there's going to be emotions involved. So if your tenant suddenly can't make the payment or there's some issue and they give you a sob story about their kids, so on and so forth, you don't have that buffer of a professional in between. So there's emotions involved. You might be losing on your investment because you get emotionally connected. Or
well, not only that, leverage your time.
100%.
What can you be doing with that time that you're taking up managing the property when you could be putting that into work elsewhere and making you more money?
And if you're working with a legit, again, you've got to find legitimate pros, but if you're working with a legit property manager, my brother is one of these, like he's an absolute stud, one of the best. He gets headhunted by all the biggest companies in the nation all the time. Well, he can ratchet up. Well, there's going to be a cost for the pet. There's going to be a cost for this extra parking spot. There's going to be a cost for so on and so forth. And we're not trying to nickel and dime people, but the reality is your competitors, as a landlord, the apartment complexes or whatever, they're charging these same fees. So you got to have somebody who's knowledgeable and literally, say somebody worked with my brother, for example, because of his expertise and abilities and knowledge around this space, he could make the owner more money than his cost would. It would be a profit center for the owner, not an expense for the owner, for most people, which is crazy.
Well, that and rents change so fast.
Right.
Who's to say if you're a landlord, you know what the rent game is looking like if you're invested 100%. into your full-time job.
Yep. Because you just don't exactly. This is our full-time jobs. This is all we obsess over all the time, all day, every day. And then one last thing is tax advisors. I see way too many of our clients filing taxes on TurboTax or whatever. When you own real estate and rentals, you need even if you're going to do the filings yourself, you need somebody in your corner that can give you advice, strategies, thoughts, ideas. So, for example, accelerated depreciation, that is starting to phase out, may phase out completely, but with Trump in now, maybe it comes back because it was a Trump era implementation from his first term. But this accelerated depreciation, if you own a rental property, I mean, I know people that are literally making $100,000 in tax profit because they go buy a rental, they accelerate depreciation, and they literally get a refund or they have tax-free income that year and making $100,000 or hundreds of thousands, at least tens of thousands of dollars in tax profit because they've got the right advice. And it might have cost you a couple of grand to talk to this person to save 50, 100, 200,000. Like, you got to broaden the perspective.
Which then that can set you up. If you're making that kind of money off of taxes, what can you do with that? Can you invest in other areas and then maximize again?
Legitimately, you have enough to put a down payment on another rental.
Investment property. Do it
because
all
you bought
again.
that one. Yeah,
rinse and repeat.
It's like perpetual. It doesn't end. So I guess I would just say optimizing leverage is a critical piece. So many people get freaked out because it's a big transaction. They feel like they got to save money and nickel and dime and penny pinch. You're losing money every step of the way if you take that approach. You've got to have professionals in your corner. You've got to be objective and holistic in your thought process on how you structure your financing for real estate investing to really capitalize on it. And if you don't, you might still be a homeowner. You will certainly still become a homeowner. The return on investment will be tremendously less. And I don't know a single person in my world that if you say you could buy a house and be rich over time, or you could buy a house and be richer over time with almost no difference in your life, 100% of the time, they're going to choose the option to be richer.
Yeah.
And that's what we're telling people. This is what we're talking about now, is there are ways to leverage and become richer with virtually no change. So anyway. Anything else you got?
No, I'm good over here.
Cool. Thanks for tuning in. Catch us on the next 2 episodes. They'll be really good, just like this one. And also, check out lassigteam.com. Soon, we are going to have the Holistic Mortgage Planning book published on lassigteam.com, which is going to go into depth on all of these topics. I'm working on finalizing this now.
Literally a blueprint that you could copy and paste to your scenario and run with it.
Yep, 100%. So keep an eye out for that. Please like, follow, comment, give us any feedback you have. We would love to hear from you. And thanks for tuning in.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.